As the Federal Reserve gets closer to raising short-term interest rates for the first time in nearly a decade, your bond portfolio might need a quick checkup. I'm joined now by Priscilla Hancock, global fixed income strategist at JP Asset Management. All right, Priscilla, it's good to have you here. Of course, it's anyone's guess as to when the Fed will pull the trigger, but many economists are now pointing to a December rate hike. So what should people be doing now to their bond portfolios to prepare for higher interest rates?
Well, I think the real question is how high interest rates are actually going to go. I mean, the Fed's told us they're going to be extraordinarily cautious. A small rise in rates at the front of the curve is already priced into the bond market. As we move forward, as the pace of rates, happens over time, obviously we expect the short end of the curve to move up a little bit. But given the dynamics of quantitative easing around the world, fairly slow growth, it's hard to imagine that rates at the long end can move up significantly. So that's a fairly benign environment for interest rates. I think the first thing people should do is not rush to short-term investments because they think that they're going to take duration out of their portfolio. In fact, that may be the riskiest part of the curve. We strongly believe in diversification, a mix of traditional core, aggregate-like type bonds, high quality, intermediate duration, combined with some extended sector, global, high yield, and then maybe some unconstrained debt to bring down your overall portfolio volatility. But in the face of the low rates that we're seeing today, one of the sectors we really, really like is corporate high yield.
And why is that?
Well, spreads there are about 60% wider than they were a year ago, and default rates remain low. Now, of course, I have to caveat this, ex energy, ex metals and mining.
Right.
But with 60% greater spread and very, very low default rates and fairly attractive fundamentals on the corporate sector, we think you're being highly compensated for what is a very moderate amount of risk.
All right, and what about the housing sector?
Well, the housing sector, the area we particularly like is actually commercial mortgage-backed securities. On the residential side, of course, with rates low, you're having not as much cover if rates start to move up, and of course you end up with duration extension risk in the mortgage-backed security sector. So we really like the commercial area there. It's benefiting from the improved economy in the United States,
right.
And that's an area that we do like.
All right, are there any types of bonds or sectors I should be avoiding in the face of rising interest rates?
Well, one of the areas we're a little cautious on is the emerging markets, and of course that's consistent with what the Fed told us, that they're cautious about the emerging markets. The emerging markets are suffering, of course, from the fall in commodity prices globally. Many emerging markets are commodity exporters. And the other thing you find is that many emerging markets who have current account deficits, they fund those deficits in dollars. So if we start seeing interest rates rise here and a strengthening dollar, that becomes expensive for many emerging market countries. So we're very cautious on that sector.
All right, let's talk a little bit about government bonds. You say yields on the 10-year Treasury will reach about 2.6% by the end of this year and 3% by the end of 2016. I mean, is that enough income to overcome a decline in price as the Fed moves?
Well, I think even the Fed moves, as I said earlier, it's going to be such a slow, gradual rise in rates. And if you think about the message that they're telegraphing is that they're really going to be cautious and they're probably going to pause when rates don't get that high. We're assuming that they pause when the Fed funds rate, the real rate, is essentially zero. So that's with an inflation rate of about, let's say, 175, 180. Let's say they pause there. And if they're good at telegraphing that, typically at the end of a rise in rates, you see a flat yield curve from 0 to 10 years. Well, if they pause at 175 or even 2%, that would mean a 10-year at 175 or 2, and that's really where we are today. So that's really not a big move in the long end of the market, and so the coupon you're getting there does compensate you.
All right, what about bond funds in the face of rising interest rates? Is that something people should be worried about? Because bond fund managers aren't necessarily holding these bonds until maturity, right?
Well, that's absolutely right. They're actively managed, much in the same way separately managed accounts are often actively managed. I think the fallacy that's out there is that there's a different math to bond funds than there is to individual portfolios. In fact, it's exactly the same, that if you buy a portfolio of bonds today, let's say it has a duration of 5, whether it's an individual portfolio or a mutual fund, the math of fixed income is the same, and that is that your total return will be very similar to the yield you bought in at, assuming you hold it for the duration. The difference you really have to focus on is individual bond managers and how they're managing their portfolio in the face of rising rates.
All right, Priscilla, we'll leave it there. Priscilla Hancock from JP Asset Management, thanks very much for your time.
My pleasure, thank you.
I'm Scott Gamm, and you're watching The Street.